Solar eclipse and the impact on markets. Welcome to a vlog on behalf of the Foundation for the Study of Cycles, today, April 18th, 2024, with your host, Ron William, FSC Development Director. On our opening slide, we focus on the key areas of cycles, the mysterious forces that trigger events, in the context of the new book that has just been republished, scientific model of natural phenomena as a way of us better understanding indicative systems and how they work. Solar eclipse, a brief spotlight on the subject matter itself, and then the market switch in what has been called a behavioral inflection pattern. Specifically, we'll look at S&P 500 and NVIDIA as a key proxy to risk appetite. And then to close, final insights. For FSC members who would like to have more resources, there's also a related media interview that shares additional information. Cycles, the mysterious force that triggers events. So following the paradoxical theory designed by Schumpeter on creative destruction, it warned that only during signs of crisis or uncertainty that seeds of new adaptive thinking can be considered. Certainly this was the case in the 1930s during the Great Depression, which led to the rebirth of cycle research, and notably the work of Edward Dewey in his establishment of the Foundation for the Study of Cycles. Dewey's original investigation of potential causal factor of crisis at the request of US President Hoover later evolved into his book, Cycles, the Mysterious Forces That Trigger Events, republished this year. Its groundbreaking insight was likely the cyclical DNA blueprint in both nature and markets. And that is what we focus on today in the FSC vlog. Now, this helps bridge into the roadmap signature cycle, which I now use, originally developed by mentor and veteran market strategist Robin Griffiths, who later expanded in joint work together based on the original version of Schumpeter's triad framework. You can see here pictured on the left, based on Kondratiev, jugular, kitchen, and seasonality cycles. Now, the mainstream industry study seen this very much as a fixed pattern, but often marked by occasional outliers. Now, in my own industry research, more than a decade ago, while working at a global macro fund, there became an intensified research into plausible influence of nonlinear timing and natural cycles because of these outlier outcomes. As with most new adaptive frameworks, a new model of understanding was back then and now required. And so I put it to you, for those of you who are on that search at whatever stage, the following slide will be hopefully useful as a reference. So the scientific model of natural cycle phenomena, I'll share with you two examples. There are more that have followed over the years. This one, pictured on the left, is a scientific feedback model developed by Dr. Campion of the University of Wales, where I now study. It features the cause-effect process resulting in fluctuations within agriculture market, the economy, and socio-political change. Cycle pioneers over the centuries proposed such theories, notably British economist William Jevons, which I can speak about more in future, Russian scientist Alexander Chesky, which has previously been spoken about by my colleague Lars von Thienen, and available on the FSC YouTube channel. Both used sunspot cycles as key proxy for natural phenomena, whereby changes also happened in mood and markets. The latest solar eclipse is another marker of impactful natural phenomena. And I want you just to trail your eye from top to right. But as you do so, keep in mind the bottom left-hand side, which connects each of the rest of the sections, allowing for a direct connection to human beings as collective psychology and mood through their biology, which we'll follow up in a moment, but also transmission in other ways. Another model, which is indicative of causal factors, was developed by Ray Tomes, FSC science director. He shared this in 1989 during an FSC conference. It's a more complex variation of the prior model, including more detailed links to macro systems of Earth and the economy. The full paper is available upon request. Additional insights also can be found within the FSC video series themed Introduction to Harmonics Theory, hosted by FSC Chairman Richard Smith. Moving on to the solar eclipse, which is the theme at hand, and a brief spotlight. Solar eclipses have long been a source of human fascination. These celestial events, where the moon passes between Earth and the sun, casting its shadow upon the Earth, are shrouded by myths and legends, but also scientific theory. Beyond their astronomical significance, solar eclipses also influence various aspects of climate, macro systems such as the economy, the market, as well as collective mood. Fun fact, the tablet here that you see is going back to Mesopotamia and Babylonian times. And back then, they were actually doing complex math of all of the astronomical events, including the solar eclipse. Now, switching from ancient times to the last 100 years, the subject of heliobiology was created by Russian scientist Alexander Chizevsky, which focused on how macro systems impacted the mind, but more specifically, the biology of the human being in what he called heliobiology, the sun's geomagnetic impact to life, human stresses, often leading to mass excitability, particularly if crowd sentiment is already vulnerable and hitting extremes. That's an additional preface from myself just to connect the dots between here and now and how this might impact behavioral sentiment in general, particularly if we're talking about macroeconomic or financial markets. Chizevsky also proposed that human history is influenced by an 11-year peak in sunspot activity, triggering humans en masse to act upon existing grievances and complaints through revolts, revolutions, civil wars, and wars between nations. Dewey and Chizevsky may have corresponded and shared research. My understanding is that insights may have also been published by the FSC, more to be confirmed in future. Watch the FSC video by Lars von Thienen on solar cycles and war, including Chizevsky's research. Now let's take a step back and remember the solar eclipse that many would have watched either in person in parts of Mexico, USA, and Canada, and the rest from afar on a screen. Essentially, that was a collective sense of awe. And so there's a psychological and even spiritual impact from that, which is something to take note of. A 2022 study published in Psychological Science, later on featured in Forms magazine, analyzed nearly 3 million Twitter, now X, posts following the 2017 previous eclipse to find a significant increase in expressions of awe, pro-social behavior, and a stronger sense of community among people. Now, the two key factors for this were collective sense of wonder, just cited, and the other, this reminding of universality of human experience. Partly for this reason, most expect the solar eclipse natural phenomena to be positive for both collective mood and markets. Now, to bridge that connection between the solar eclipse and markets and this idea of collective awe, positive mood, rooted in psychological research, additionally, equity market performance analysis on solar eclipse years are mostly positive, but with some negative outlier. Although my key premise here is grounded in the important context of macro market and sentiment going into and out of any event, including a solar eclipse. So do look at the three key points highlighted: behavioral sentiment, stage of market cycle, and potential event risk. More to follow in my final insights wrap. And now to fast track to markets here and now so we can reflect on potential investment and trading educational guidance. Going back to Earth's gravitational themes, the market's behavioral inflection point, which I've discussed before at FSC vlog posts, that reversal pattern is likely in play. Watch S&P 500 and NVIDIA as a proxy of risk appetite at key levels of 5,000 on the S&P 500 and 830 on NVIDIA. A triple whammy of headwinds remain: momentum extremes, rotation fragility, and cycle risk, all still warn of a potential correction into Q2 2024. Now here's the visual on a chart mosaic of the S&P 500 market breadth and the FSC cycle model. So behavioral inflection pattern just mentioned on the S&P 500 is confirmed if 5,000, the psychological level, is breached, ideally with a weekly close. The downside trajectory would be at least 10% if you look at that rising channel from late 2022, which would be a base case scenario. The technical indicator, however, is now oversold post breakdown from a 5-month bull regime. And I'll just quickly highlight it for you on the screen there. That's the oversold condition on a volatility Z-score measure. And looking at the top right-hand side, figure 2, there's material deterioration on breadth internals sub 30%. This measures the number of tactical or medium-term trends that are still rising. So practically speaking, 70% of tactical trends are down, only 30% are up. So that is material deterioration. Could lead to an oversold bounce. The question is, do you fade that or do you look to buy on the dip? This will be a top of mind point for many investors and traders. There's a confluence of timing signals. The FSC model is now realigned with the price rollover, which was divergent before. We also have geometry cycles, which I'll follow up on the NVIDIA chart following. Natural cycles like the Eclipse plus others. You can see there the short-term risk cycles highlighted on the chart. As well as event tail risks such as macro data surprises, hot inflation, likely policy shifts with certainly the Fed in the US likely not to cut at all, or even if they do, not cut by much, and broadening geopolitical tensions with the latest headline news of the Iran-Israel strike, where a feedback loop has just started between the two. Looking at NVIDIA and its parabolic rise, which is now also being eclipsed, and serves as an important risk appetite proxy, whatever may happen. You can see here it's a double eclipse, both lunar and solar, but most importantly, it ties in with market geometry overlays the 360 cycle based on techniques from WD Gann, squaring price with time, and also the price target itself is overlaid from a similar technique. Watch this potential break under key support at 8:30 to suggest a short-term reversal in play. A variation of ancient wisdom reminds us, cometh the moment, cometh the event, a nuanced cause-effect model led by time patterns, a useful reframe, whatever market or life event you're reflecting on. Practice ahead of any important changes and say to yourself, it's just time. At the same moment, keep your behavioral biases in check and let the market decide which way it wants to go. Confirmation and follow through is going to be key. But certainly, whatever does happen, do recall the practice of it's just time. Looking back in time to 2000, the tech boom, bubble, and crash is a useful historical rhyme pattern that continues to offer a analog for typical irrational market behavior. The latest rollover signal just happening here. You can see yellow is the current price action and blue is the one past compared to present. Signals the music is likely over for now, and a three-stage corrective pattern, ABC, or as per the roadmap model that I follow, WXY, is signaling three key stages of that corrective move. The first, a fall, which we're currently having, but we'll see how much a fall that is, whether it's up to 10% or more, leading to an oversold rally, but not a new all-time high, according to this model. Then the rest of the fall. Now, this is a model, and ultimately reality will deviate in and around that reference point. But if it were to stick to this model, it would be a sideways volatile market for some time, aligning with the negative seasonality of May, coming month, as part of that sell in May and go away season, with potential oversold rallies over the summer, but ultimately the rest of the fall during the typical volatile months of September and October, leading into the US elections. And I'll just highlight it, the US elections round about here, where we get the rest of the fall and more clarity in trend. Also useful to reference the magazine cover indicator chiming in with peak one, if and when this is confirmed as a potential contrarian indicator. Okay, final insights. So based on this research and insights that are being shared with you, a few things that are come to mind that are important. The first thing is that not all solar eclipses are the same. This is a whole discussion in itself, but keep this in mind when you're doing any type of analysis, particularly if it's market or statistical type analysis, because of course it means that you need to take into account the different nuances. On a very simple level, the three main variations include total, partial, annular. Although eclipse season is typically twice a year, a total eclipse is more rare. Also, a double eclipse, solar and lunar, is that much more rare too, and we've just had that. As you might expect, this will be more impactful across the board: nature, collective mood, and markets. Now, each solar eclipse also has a flight path over Earth. The next one over the USA is August 23rd, 2044. So we do have to wait a few decades for that. Meantime, the sun will be traveling to other parts of the world. And in doing so, there may be a solar Earth impact to where it decides to go to next. That can also naturally influence socioeconomics of the region. Second insight, the macro eclipse signature this time around is unique for different reasons. Latest scientific research highlights the current macro eclipse signature is producing a unique electromagnetic force able to trigger large seismic activity and tremors on Earth. This helped them correctly predict recent earthquakes. Meanwhile, based on psychological and biological studies, part of the same force is also intensifying human stresses, leading to what I referred to before based on Krzyzewski's work, mass excitability. Remember, this is particularly important if the crowd sentiment is already vulnerable and hitting extremes. Of most concern will be the current unwind of investor risk appetite if it continues, and potential for further geopolitical escalation. Good time to stay alert, whatever happens. And to close, the latest geopolitical risk in the headlines in recent times between Iran and Israel confirms industry peers BCA Geopolitical Strategies view since October 2023 that the conflict is likely to expand in Israel and the region. For now, as a reference to external expert views, BCA do not upgrade the odds for an oil shock, which is the market impact that is top of mind. Instead, recent events vindicate a 30% odds based on their perspective of a major oil shock, which could be recessionary before the US election, and 46% of a minor oil shock, non-recessionary. My view is to expect further gains in commodities either way, because relatively speaking, they're oversold. Also due a super cycle performance ahead, as well as the likely inflation higher for longer trend that will support. In a geopolitical risk situation, agriculture and energy sectors are useful proxies with the risk of disruptive price surge. Keep in mind, geopolitical alpha could escalate, compounded by vulnerable and cosmically awestruck investor sentiment. That's it from me, Ron William, on behalf of the Foundation for the Study of Cycles, Solar Eclipse, and Impacts of Markets. We've looked at cycles, the mysterious forces that trigger events, scientific model of natural cycle phenomena, solar eclipse brief spotlight, behavioral inflection, looking at that theme on S&P 500 NVIDIA, and then final insights. Please feel free to stay in touch, either on social or email. Thank you for tuning in, and I look forward to connecting the next time.